Okay, we are live, everybody. So I just want to check with you, Eve, just while we're here. Will we start to see people coming in? I can see it now. Okay, that's great. Okay, excellent. Okay, hello, everybody. Welcome to this webinar that we're going to be doing, which is focused on how to scale a clean tech business. Thank you for giving up your time today to join us. I will do some introductions shortly once we have a few more people coming in, and we'll go through kind of what we're going to cover today and really the key things that we want to kind of get across, particularly in the clean tech space, but also about how you create valuable businesses. A lot of what we are going to talk about is also the investment side within the space, the key trends, the key things that are happening in the market. We'll talk about drivers of value. So again, if you have a clean tech business or you are an investor in one, then the things that you should be looking for in terms of how you grow and scale that business with intention, so that you are going to get to the most positive end result of what you're trying to achieve from that. So we have at the moment around about 20 people who are here. We've had quite a few people sign up. So the plan really, just so everyone's aware, is this is going to be a fireside chat format. You'll be glad to hear that it's not going to be death by PowerPoint or any of those things. I'm sure you're sick of that. We're going to talk for about 20 minutes around the various topics, but we want to make this interactive. So you'll see that you have the opportunity to effectively raise hands, ask questions, those sort of things. I'll have the Q&A open the whole way, and I'll make sure that there are certain points within today's webinar that we can answer specific questions. So I think it's best if people do want to get into certain things as we're covering various topics, just really post your questions and we'll make sure that we get through all of them through the session. Expect we'll go for probably 30 to 45 minutes based on that, so it won't take up too much of your time. But as I said, we want it to be as interactive as possible. Alrighty, so let's get into some quick introductions. So David, do you want to do an intro for yourself first, please?
Sure, yeah. Good to have everybody on the webinar here. David Hunt, I'm the CEO of Hyperion Executive Search, which is the search firm that works exclusively in clean tech across North America and the EMEA region. I'm also the host of the Leaders in Clean Tech podcast, where I interview CEOs and founders of clean tech businesses and talk about their scaling journey. And I'm also a mentor for some clean tech accelerators like Plug and Play, based out of San Francisco, Foresight out of Canada, Green Tech Alliance out of Berlin, and various others. So I live and breathe clean tech and scaling businesses through addition of or acquisition of talent, and of course, introduction into VCs is what I get up to day to day.
Okay, excellent, David. You've got your hand raised there.
Have I?
I think you have.
I
was going to say, have you got a question to start off with today? Okay, excellent. Listen, Rob Williams, do you want to introduce yourself as well, please?
Yes, thank you very much, Nick, and hello, everybody. My name's Rob Williams. I'm co-founder of the Fielding Group. I'm here today in two capacities at opposite ends of the spectrum, really. So I'm a non-exec director of Emercher, and we work with seed stage businesses, helping them develop investable propositions and support them through that funding pathway. But at the other end, we also work with the global law firm Squire Patton Boggs in helping them source excellent clean tech ventures that are sort of at the stage for acquisition as part of special purpose acquisition companies. So right at the other end, where we're looking at sort of 100 million plus, back to Emercher, where we're looking for people that might be raising as little as 250K. But I'm here today to share my experience with you really around what makes a business investable and what sort of things should you be focusing on to be able to use investment to fuel your growth.
Okay, excellent, Rob. So a quick introduction who I am. So my name is Nick Bradley. I've spent my career buying, scaling and selling businesses, over a decade in private equity. And I was involved in a lot of the evaluations of what businesses we would invest in those private equity firms. I was also the operating partner that would go into firms, into portfolio companies that needed to have, the right things put in place to maximize value. I've been involved personally in 24 successful exits. The last one that I was involved in was a business. It was actually in the education space. It was called Ascend Learning. We sold that business to Blackstone Private Equity for $2.3 billion in 2017. And I was the chief exec of all the international division of that business. These days, I am an investor. I work with entrepreneurs and investors on strategic scale up. I also have a podcast, which is called Scale Up Your Business, which has just over 250,000 downloads in 130 countries and has been ranked #1 in the UK and number 17 in the US on the iTunes business charts. So quite a deep level of experience, and I'm a bit of a geek, to be frank, about this stuff, all things scale up. Cool. Okay, so let's kick off. Just so I can get a sense, and I'm not the most capable Zoom moderator here, but I'm going to try my best. I'm going to try and get a bit of audience participation. I just want to get a sense of who we've got here. We've got about 23 people here listening in. Can you let me know if you currently have a clean tech business? In other words, you are a business owner, an entrepreneur. I just want to see, just by raise of hands, please. So you'll see there's an option to do that. Okay, brilliant. This is working. Awesome. Okay, so we've got around about half of you currently have a business that's in the clean tech space. Fantastic. Okay, so if you can just lower your hands now, please. How many investors do we have? Investors either in the clean tech space or are investors generally who are interested in this space. Okay, so we've got a couple. Okay, and we've got a whole heap of people who are somewhere in between that. So we may get you to let us know exactly what that is as we go through. All right, so let's kick off, guys. So David, first question to you. I mean, you've been in this space for some time now. You've got a strong reputation and you advise a lot of these businesses. What are the key trends that you're seeing, both from a kind of market perspective, but also in terms of any specific subsectors, if you like, of clean tech and that whole industry, as we call it?
Yeah, I think one of the pleasing things is that what was very apparent, despite last year being very difficult for many businesses, that the deal flow didn't loosen up in the clean tech sector. So we look at figures out last week from Bloomberg New Energy Finance that there was $503 billion invested in 2020, despite the pandemic, across the clean tech space. Some of those hot areas at the moment are anything in and around batteries and battery storage, both from a mobility perspective and from a stationary storage and a grid perspective. There was an increase actually last year to 5.5 billion deals globally in that space. Anything around mobility, electric mobility, smart cities, there's an awful lot of investment and a lot of activity going on in and around that sector. And one of the hot ones, which is, I guess, verging on maybe a little bit of hype or over stimulation focus, and that's around green hydrogen. But that said, there is some significant investments and significant opportunities around green hydrogen, where that might play its part both in the energy transition and the mobility transition. So those are probably the hottest sectors. So anything in and around batteries and the grid, anything in and around mobility and transportation, and green hydrogen are probably the three areas I would say that where there's the most activity in terms of investment and growth at the moment.
Okay, excellent. And of those particular ones that are, as you said, are hot, what are some of the characteristics? Because I mean, we had a conversation before we started this around when, let's say, a venture capital firm looks to invest, they're now getting experts on their panels to start to validate and qualify whether these businesses actually have something, because a lot of them are, let's call it, intentional in what they're trying to do. The science looks like it makes sense, but sometimes the evidence isn't there. So what are some of the things you're seeing around that?
Yeah, certainly seeing a lot of interest in the corporate VCs and institutional investors who are making acquisitions. The most obvious one would be Shell New Energies, who've recently bought a few of our clients, including Zonnen and Ubertricity. So people like that, BP, and a lot of institutional investors are looking for startups that they can acquire and use that as a way to leverage their business and or invest in those entities. So as a founder, those are certainly, I think, stronger than it has been in the past. And the clean tech VCs that I work with and speak with, there's a mix really. I think the sweet spot is where there's an element of both digitalization, i.e. software and hardware. There are some VCs that will invest purely in SaaS businesses or in software businesses, but broadly, I think the sweet spot is where there's an element of infrastructure product with a software solution and or element digitalization of that. And those are the areas, again, more specifically where there's a lot of investment, and a lot of smaller companies are actually getting quite a lot of interest over and beyond their sort of state of growth.
Okay, interesting. Let's I'll just pivot over towards Rob Williams now, just to talk about more broader, I suppose, investor landscape, Rob. So with your involvement with early stage businesses, seed, Series A, and also your work with the Mercher, what are some of the things you're seeing with that investor landscape now, particularly with a view on the clean tech space?
Yeah, we're seeing a lot of founders taking advantage of some of the innovation funds to be able to bootstrap ideas and invest in research and development to be able to meet some of the most pressing needs that we're seeing in the sector at the moment. And clean energy projects are of particular interest for some of those early stage investors that are seeking things that are interest them really, that are sort of environmentally or societally sound. I certainly find that a lot of angel investors are now investing in opportunities that meet their own values, and they have a specific interest in. David mentioned VCs. There are two schools of thought in VC. I think sometimes the ability to be able to generate value within a certain time period aren't in line with the kind of returns that VCs are looking for. But VC's whole perspective on investing has changed massively over the last 3 years with regard to, again, ESG. They want to demonstrate that they're investing in sound projects that meet the values of the firm in the way that sort of modern day finance is now positioned. So I think 2021, particularly with the Biden presidency, we'll see a massive release in opportunity, and I think government funding or incentives for individuals to start clean tech businesses or clean energy businesses, and I think we're going to see more good ideas coming into the marketplace and more incentives for investors to be able to invest in them.
Okay, excellent. I think what we'll do, I've got a couple more questions for David, but I am going to just remind, we've got around 25 people here at the moment. If you have got questions, I noticed that half the audience here are owners of a clean tech business in some shape. So use this as an opportunity to ask any questions around any growth challenges you have. I think, as you'll see from who we have here on the panel, we've been involved in various different things, and we can probably get into some structure around that. I am going to go through some principles of value creation on tonight's webinar as well. Before I do that, though, David, what's your view? And this is interesting. Is the market becoming somewhat fragmented? And by that I mean it's a hot space. There are lots of businesses wanting to start in this space. A lot of them are doing, I'm not going to say the same thing, but they're doing similar things. And we said beforehand, sometimes it's hard to validate or qualify the science. Do you see an opportunity for collaboration and or mergers of some of these businesses, even though they're still early stage? Is that a trend that you think will happen? Just so there is a level of scale and certainty that can be created from that.
Yeah, I think there is. And I think something that's born from that is, again, working with quite a number of accelerators. The number of accelerators and incubators, I think, has grown quite substantially over the last 2 or 3 years. And a lot of those are using the platforms to make introductions where there are sort of very early stage, either mergers and or collaborations between companies who are in a similar space or have a technology which clearly can align to address a problem for example, for a utility or for a larger entity. So there is quite a lot of collaboration and potential for merging and or partnership at an earlier stage for companies who are still sort of very much early in their founding.
Yeah, okay, good. Well, we've got our first question that's come from the audience. So Eric has asked, what are the 3 most important qualifiers for being a sustainable clean tech solution? Scale up with unicorn potential. I can always talk about the unicorn potential. Lots of people want to know the answer to that, which is great. I'll jump into it from a more broader perspective because we'll get into this. But what do you think, David? Again, as a clean tech expert here, anything that comes to mind from that question from Eric?
Yeah, I think it's really interesting. I was talking to again a couple of US VC CEOs this week on my podcast around value creation and growth, and we were looking at some of the statistics around companies who had set out purely to become unicorns as opposed to companies who followed the mission, and invariably the ones who were mission led actually did better financially than those that were purely exit led. And I think there's a bit of a balance, tightrope there. Clearly we're all in this, or most of our clients, most of the people we know are in this for an exit of some description and to clearly make some wealth for themselves and or others. but businesses who can demonstrate that their product or solution genuinely impacts positively, be it the environment or society or both, are the ones that are getting most traction. You touched on the point, actually, a lot of VCs and institutional investors are focused on ESG, so they're focused on, is this making an impact? And regardless of, not say regardless of, but it's as important as the financial viability of the product. There has to be that synergy. So I think it really has to be a product or a solution that does have an impact or has the potential to make an impact. And going back to unicorns, clearly the bigger the impact or the potential impact, the greater the opportunity. But it's quite tough to find something which is, you know, literally game changing, a phrase which is overused to some extent, but there are still areas. Green hydrogen, potentially one that's got a lot of interest, where it could be really game changing. And if you've got a technology that can do that, then clearly there is the ability for unicorn status. A good friend of mine, Christoph Osterman, almost got there. He sold out to Shell, just shy of $1 billion, I think, but you know, in a 10-year frame from zero to the best part of $1 billion exit was pretty good going. But again, that was a technology where they really believed in it. They were mission led. They were able to scale, and yeah, I mean, we have to focus on the money, particularly on a webinar which is focused on growth and exit. But you have to really have faith and believe in the product and the solution, or the VCs will see through that, I think.
I think Eric's going to steal the show tonight. Eric's got multiple questions. I'm going to ask you, if we don't answer these effectively, Eric, you can give us some feedback as well, by the way. I'm going to jump into the second one that Eric has asked, because I think it's more in line with the stuff that I've done. And just to also be clear, I've been involved in 3 10-figure exits personally, or going back now 15 years. So, you know, I wouldn't necessarily call them unicorns in the traditional tech definition of that, but they were businesses that sold well into the billions. So I can tell you, let me take you through what I think the key characteristics are. Okay, and this is applicable to any business that's in a scale-up journey to exit. And again, if someone is looking at that business for sale, be that private equity, be that a more strategic buyer, an institution, they look at the same characteristics. And I don't think this is necessarily going to be something potentially revolutionary, but it's the precision around these 6 areas that are important. Okay, so to answer your question, you said, what are the 3 structural challenges? I'll hopefully answer that by talk about the 6 areas. So more often than not, when a business is going through scale-up phase, there are a number of different things that happen. So the difference between startup and scale-up, the main definition that I talk about is the ability to build teams and to lead those teams effectively. And it's the ability to work with structure, process, whereas a startup phase of a business can be very creative. It can be a lot of fun. It doesn't usually have a lot of structure around it, because it's usually the creativity of the entrepreneur or the entrepreneurial team. When you go into scale up, that doesn't work. And I often say that people who are exceptional at starting businesses are not necessarily the best at scaling them, because it takes a very different skill set and mindset. Now, that's not to say that means that the founder of a business can't take it all the way through to being a unicorn, because there are many examples of that. But what you don't see is the identity shift that person, that leader, makes through the journey. And there are plenty of examples where it hasn't worked, Google being one, where good old Sergey and Larry had to bring in different levels of leadership and management to take the business to the next phase. Okay, you could argue there are failures of that as well with Apple, and there's different transitions around it, but in principle, that's what it's like. So the first area is you've got to have absolute clarity of the vision of what you're creating. Okay, now you may not know what that looks like in totality, so you don't know exactly what the path is going to look like, but you need to know exactly what the destination broadly looks like. And that vision needs to be big, it needs to be emotive, and it needs to be clear why you're doing it. So another question that's come up is around purpose versus profit. I don't necessarily think that there has to be a massive differentiation between the two. I think both of those things can exist very neatly together. In fact, Elon Musk, who was on stage in Clubhouse, if you guys know that app, a couple of days ago, he spoke about this exact topic. He said that if your purpose is big enough, if the problem is big enough that you are solving, the profit will take care of itself. Okay, so again, I think in this particular sector, the clean tech space, and how transformational it can be globally to societies, all that sort of stuff, it's a big enough problem that needs to be solved, right? The second area is understanding where profitability is going to come from. Now, I've been involved in many businesses that have sold both at revenue stage and profit stage. But I can tell you now that, when you have either the pathway to profit or you have profit, that is where the kind of the investors and or the purchasers are going to start to see the multiples of what they're going to pay you increase substantially. Now, there are some other categories around that which I'll get into, but you need to understand where profit's going to come from. One of my clients at the moment is a fintech. They're not profitable at the moment, but they've just raised over £100 million because they can clearly articulate the pathway to profit. So they're going to be invested in, pre-profit, but it doesn't matter. They can show that. The third area is what I call your proposition, your overall value proposition. And I'm going to pause on this one because I'm going to ask David another question here. Because the value proposition is not necessarily the product or service, it's the whole experience. And one thing that's interesting here is, back to my question around sort of fragmentation, is are you seeing, David, that a lot of the same, I'm going to call it the same solutions to a problem are starting to come to the forefront? They might be nuanced through these different startups. In other words, they might say it a little bit differently, but to be totally honest, it's very hard to differentiate. Are you seeing that, or are all these businesses so clearly defined that they therefore have a chance to be able to be remarkable and stand out?
No, I think there is certainly in certain areas, mobility, again, we touched on, where there's a lot of interest, and to some extent it's a relatively cheaper market to break entry into. And there are a lot of companies, both software platforms and hardware solutions around EV charging, for example, where it is a little bit me too. And therefore the real innovation has to come not from the technology, but from the business model. And there's a lot of focus, there's a lot of interest in how, because in a lot of these markets are quite nascent, and it's not always easy to know where the revenues are coming from, or how you can stack revenues sufficiently to get commercialized or past that commercialization stage. And so a lot of business model innovation, how you can be unique in how you position the product and how you take it to market, more than the product or solution itself.
Okay, no, I think that's true. I mean, we have in one of the businesses that I have, we do work with a couple of clean tech businesses, and we've been helping them with this challenge to some extent. And a lot of it's not necessarily changing what they're doing, it's the narrative or the story around it, so it stands out more. So I bring that up because it's the third area, so it comes under proposition. The fourth area is predictability. That's the predictable flow of the right customers driving recurring revenue in some way, shape, or form. Again, I'm talking about this more broadly. It's not necessarily applicable to just the clean tech space, but if you can prove revenue predictability, that's a value driver. And it can come from subscriptions, it can come from long-term contracts, it can come from really dominating a market where you literally are the only solution. But the point is, you can see the predictability of how that's going to come. Then we move into process, which is the fifth area. So the ability, again, the question here is around the things that are needed to scale up. So you need to be able to work with process systems and automation. Again, the best businesses that I've been involved in have clearly defined processes of things of customer acquisition, how delivery is done, financial management. And a lot of this, a lot of entrepreneurs, particularly early stage startup businesses, totally understand this. They understand it's needed, but it's not where their center of energy is. And this is where, there's a question that's coming up about who you should bring in, who you should hire. And this is where, there's a definite, an important role that needs to be at a very early stage, which I'll get you to answer, David, but I'm sure we'll probably agree on it. And then the last one is absolutely people. And a lot of businesses, particularly with what I anticipate if people are listening to this tonight, they're thinking, well, I've either raised funding or I want to get funding, I want to impress investors. How do I do that? And to be honest, when a lot of businesses are pre-revenue, a lot of it's backing the individual, backing the team that's going to deliver this thing, particularly when it's so new that there isn't a lot of certainty around the proposition in its own right anyway. And so having the right team around is absolutely critical to that whole decision. That's the capability, it's the track record, it's the experience. It's also a little bit about the culture that you're creating. Yeah. So often if I'm sitting on the other side of an investment table and I'm looking at, I'll ask that question, so what are the standards and values and behaviors that are going to underpin the growth of your company? Okay. And you'll be surprised how many founders have never even thought about that. But when someone can answer that question, you see the shift in the room where everyone goes, oh, this person's on it. Okay, so that's the 6 areas. It's a bit more than what you asked, Eric, because if you ask, your question was around the structural challenges. When I think about structural challenges, I'm thinking about the internal challenges. And a lot of that, as I said, is about building teams. It's about process. It's about leadership. It's about absolute clarity. And a lot of the stuff that you do internally, once you get that right, then creates the machine for scale up. Okay, so I'll pause there because I could talk forever. Let's ask another couple of questions that have come through. So last one from Eric is, I hope there is no contradiction between purposeful and profit stage. So it's more of a statement, I think, than anything else. Anyone want to comment on that? I mean, Rob, do you want to jump in on that one? Because you get involved in impact investments as much as you do the traditional finance side. What are you seeing in terms of, the blends or the challenge or the opposite of those two concepts?
I think to kind of follow up on what you were saying, Nick, a well-run business is a well-run business. What differs about Cleantech in particular, I think, is the way that organizations can leverage government policy changes driven by their environmental policies or the will of the people. So when society recognizes their behaviors need to change to protect the environment, it can create new markets. So I think that's what makes Cleantech different. But beyond that, you have to have a well-run business. You have to have a good leadership team. Now, one of the things that make you stand out, we were talking about differentiation in the sector, is your brand. And quite often the brand will come from the founder or the leader because it is a purpose-driven business. So it's their own ideals, their experiences, it's the way that they want to live that has caused them to create that business. That then becomes their brand. So I think their purpose almost creates an energy of itself by getting like-minded people to work with them, attracting partners because of their brand. Customers buy into their brand, and there are shared values and a shared promise. But you can't ignore profit. So whilst purpose is essential to be able to capture that sort of groundswell of the market, who want to use and work with organisations that share their same values for the environment, it has to be a well-run business. Particularly when you're looking at investment, an investor wants to see a leader with very, very sound business principles. They understand exactly how they're going to create revenue by delivering value to a business or a sort of a consumer, and they want to see that costs can be managed as well. One of the big issues with Cleantech from an investor perspective is the amount of investment that is required to sometimes produce something that can even generate revenue, which is what I was saying earlier about a lot of VCs still will be reluctant to invest in projects that carry a huge amount of capital because it's very difficult to see the return on investment. And David and I were only speaking last week about a venture in Phoenix that just didn't have the tangible product. Lots of theory, lots of R&D, lots of academic research, but where is the box with a product in it, with a market and a price that we can then deliver at scale?
Let's go into that, Rob. Let's go into that, Rob, because I was thinking about that as well as we were talking earlier. So obviously we'll never talk about individual conversations, but the situation here is, a fantastic vision, fantastic mission, if you want to call it that, in terms of what the intention is of this business, but no certainty. Right. And this is an interesting piece because like we get that you're not necessarily going to have the money at the beginning. It's the chicken and egg scenario. You're not going to have the money to create the certainty, to build a prototype, to test it out, to then get a signed contract with someone. So David, I'll jump onto you on this one. If there are founders listening to this and they're in that exact predicament, they've got like something drawn on paper, but they need to now get money to turn it into something tangible. What do they need to do? Because it's, as I said, it's that chicken and egg situation.
Yeah, it is, and it's tough. And I think one of the questions came in from Ben Turner. I think there are some VCs and/or funders who will play the long game, which you'll need if you do have a product or a solution which is or can be fairly capital intensive to bring to market. We've been working with a lot of companies that are backed by Breakthrough Energy Ventures, who take long-term punts on things like long-duration energy storage, and they'll put a lot of money in, not expecting that to change. There are VCs or funds like IP Group who invest in very early IP, going back to your point, so they'll invest in the IP knowing that it's going to take to some fruition to come through. But clearly they'll do a lot of due diligence, not just on the financial viability of the business, but on the reasonable prospect of that solution coming to the fore. And I think sometimes the further you get or the more you're challenging the basic rules of physics or thermodynamics, it can be tougher to get people to buy into that for very obvious reasons. So things that are, they're proven in terms of broader technology. It's just a case of how do you build something to scale that and how do you monetize it. That's one problem. If you've got a solution which could be potentially game changing, but does challenge on the fact it's never been done before, think of fission nuclear, for example, which does actually attract some money, but it's still something which is quite out there a little bit as well. But I would say there are certainly funders or places you can go for people who will bet on the longer term. It's not for every VC, it's not for every funder, as you know. Yeah, the closer you have to something which is provable and ideally demonstrable, in a pilot project or a lab project, or even something tangible that people can look and see and feel. And that can be a challenge if you're not there yet.
No, I get that. Yeah, exactly. And this is the thing we were saying beforehand, that some of the venture capital firms have got, scientists, if you like, experts on their side now doing the validation or the qualification of these different opportunities. But just I think what's interesting, and this is about navigating the space and knowing who are the people that you can speak to if you're in that situation as a founder. Because there are, just by the sheer nature, VC is effectively a spread betting investment thesis. So lots of VCs will have multiple investments. Some of them have hundreds that I've been involved in, the bigger ones, small bets, but they don't expect hardly any of them to be super successful. They only expect a few of them to absolutely end up being the unicorns. Private equity is very different. Private equity obviously is up the chain. That's where it's mainly around the value around profit. But a decent funds, 400 million plus would probably be looking to invest in 10 to 15 businesses that are later stage. So it just depends on again the different scenarios. So cool. All right. Hopefully, Ben Turner, that answered some of your question. Again, if we don't cover it in enough detail, please just post in the chat again and let us know. We're more than happy to come back to questions. We want this to be, as I said, a fireside chat format as opposed to a full-on presentation. It's really about doing some Q&A and helping people just understand what they can do if they're in this space right now.
Nick, I was just going to ask David a question on that last point. David, when we look at R&D and the activity that needs to take place before a tangible product can be brought to market, how much of that do you think is the responsibility of governments to be able to support that with R&D funding and tax advantages for businesses that are in that stage, as opposed to the VCs investing in businesses that are effectively risky?
Yeah, no, I think there's a big part to play there, and I think that's starting to be recognised, that you have to be able to take a concept or a business to a level where suddenly private money, whether that's VC or otherwise, can sort of realistically take a punt. And we've just seen this week, I think it was a £3.5 billion worth of investment from the EU broadly in around technologies for battery storage and batteries for both mobility and for grid purposes. So there are, and in the UK, things like Innovate UK, I know a number of our clients have taken advantage of Innovate UK funding and money in the early stages. Even some of those technologies which was a little bit out there, company called Zero Avia, for example, doing electric flight through fuel cells. They've had, although they're a US company, they've had a lot of money from the UK for getting them to the point where they can demonstrate or proof of concept, essentially. So I think there's a big role to play for governments and or sort of quasi-governmental organisations like the EU to fund that. But I think that's fine where you're really looking at a technology or at R&D stage. But I think from a perspective of a founder, I think a lot of ones that I speak to, both through the accelerators and also through day-to-day business, are concentrating so much on the product and not necessarily the route to market, or is there actually a place for this product? And you can understand that if you're the inventor, you're obviously very passionate about something which performs a function. But if there's no market for it, or if there's no viable market for it, then again, you're not going to get investment and you're going to be struggling. So I think you've really got to spend as much time looking at your go-to-market strategy and your addressable market as you have around the technology.
I couldn't agree more. And a lot of the, I would say the sort of million to 2.5 million revenue clean tech businesses that I see very much fall into that category. Some incredible innovation, some wonderful theory and concept diagrams, but that monetization often seems to rely on further investment, down the line. Government contracts need to be won to be able to provide it, and there doesn't seem to be that link between, as you said, a defined market, a defined need, an element of validation, and the investment in marketing and partnership and sales to a certain extent to ensure that comes to fruition. So
this touches on Jonathan Watkins' question, Rob. This touches on Jonathan Watkins' question because he's asked around new business models.
Yeah.
Because one thing we need to get across here is that you can't necessarily look at this in the same way. Because, again, I'm involved in an investment group where we're really getting deep into blockchain and looking at models around how blockchain can then be an investment vehicle going forward. Now, again, people probably hear that and think, well, I don't really even understand what this guy Nick is talking about. But there are some very intelligent people starting to look at this now. So I just wanted to address Jonathan's question in the context of what you were saying, Rob, because the answer is, he said, how do you deal with the inertia? The arising resistance within the existing ecosystem. I think my answer to that, if I've got the question right, is because there's a lot of trailblazing happening here, there's a lot of decisions that are going to be made on trust, reputation, network, those things.
Yeah.
It's funny, if you look at, and I'm going to go back and just give you an example. If you look at Silicon Valley 20 years ago, and you look at the whole concept of 6 degrees of separation, there's actually probably only 50 people, right, all joined up, who have been involved in every single one of the biggest businesses, tech businesses in the world today, right? Literally, and you can probably name some of them. You've got Reid Hoffman in there, certainly, who's the founder of LinkedIn. He was involved in PayPal early on, where Elon Musk was. Again, if you go through the list. And so proximity makes a difference, as does network. So the way you deal with that is you surround yourself with a board of people who are extremely well known or connected, and therefore the reputation will carry you, even if the business model doesn't yet make sense, because no one's seen it before. Okay, so just think about that. The quality of back to the whole 6 peaks thing I was talking about before, and the quality of the people you surround yourself with makes a massive difference in terms of whether you're going to raise funding and probably get to a stage where you could even be evaluated as being a potential unicorn. Cool. All right, I'm going to keep moving through, guys. I'm going to be very respectful of everyone's time tonight. We did say this was an hour. So I'm going to jump to another question. The next one that's come up is from Bryce, who said, when looking at scaling from a 2-person startup, what function role is the first hire, the second, the third, etc.? This is for you, David, even though I've got a strong view as well, but this is your thing. So please answer Bryce's question.
Yeah, no, absolutely. And there's clearly no one answer. It does depend on where the business is at in its stage of evolution. But I would certainly always point to initially a commercial entity, going back to your point of how do you get the product or solution in front of the right people to either from a business development at a very early stage or clearly getting moving towards having some traction in the marketplace. So I'd certainly say if it's not the current one of the 2 founders, it could be that you have a super commercial CEO, in which case it might change. But certainly you need someone out there getting your solution in front of the right people, in front of your customer base, and getting some traction. And something which I think will touch Rob's heart, the other thing is operations, because as you scale, you absolutely have to get systems and processes in place. And one of the challenges can be, how do you balance, at what point do you introduce more layers of systems and systemization into your company? You don't want too much too soon, but likewise, you'll fall over if you do too little too late. So it does depend on the founding team, but certainly first and foremost, most of the teams that we build from a very early stage, the focus is on getting the first commercial entity or first commercial person on board that can start to, I say, get you in front of the right people. Because once you're there, you can work backwards to the product. You'll get people who say, actually, this could fit the solution, but can it do this or can it do that? Or how can we implement this? But if you're not talking to the people out there in your customer base or your potential customer base, you're sat in a lab basically creating something that nobody knows about.
Yeah, and I'll give you a very simplistic answer to that. I mean, again, this is a broader answer to the question. In my opinion, it's marketing and operations are the two most important. Now, depending on which one you choose, depends on usually the founding team's level of capability in either one of those areas. So if you're great at commercial or marketing in that area, then bring in an operational team that can glue everything together. If marketing, positioning, narrative, storytelling, those sort of things isn't your strength, then absolutely bring someone into the team who can give that. Hugely important, because as I said, a lot of the effectiveness at the early stage of a business is the ability to influence, and that's the ability not to necessarily convince someone else that you've got the most amazing thing in the world. It's to convince someone else that you believe you have the most amazing thing in the world. A subtle but important difference, and a lot of that can be done through proper marketing.
Yeah. I know sort of often we get approached by companies who ask the question, do we need a COO or do we need a CCO? And obviously that depends a little bit on the existing team, but those are the two areas that are critical first and foremost, to get in front of people and then to be able to deliver on what you promised.
That's right. So just, we've got a few more questions coming through. Thanks for everyone's engagement, by the way. I hope you're getting value out of this. If people are finding it, we'll do a quick test. This is going to be one of those like embarrassing moments, but if people are finding this conversation valuable, can you raise your hand? If you think it's a load of tripe, then don't do anything. We've got one hand. No, we haven't. We've got lots, actually. That's really, really good. Okay, so most people are kind of getting value from this, which is good. Okay, excellent. I'm really pleased. As I said, we wanted to kind of just go through some concepts. We appreciate also that, particularly for a lot of early stage businesses, they don't really know some of these things, particularly what the investor mindset is. So that's one of the things we wanted to get across today. Okay, so we've got a few more questions here. One of them I'm going to ask for more clarification, but I'll open it up. So this is from Akshat, who says, how would a Cleantech VC approach an online platform that acts as an intermediary? It is focusing in process efficiency, but maintains the call center staff to deliver. If there's any additional context we need on this question, then please ask, because I'm not 100% sure. I mean, I can answer the question about intermediaries, but can you guys see the question there?
Yeah, as I'm reading it, it looks like the business is on, I guess, efficient data management in call centers. I don't know. Is that the business, and then there's an intermediary linking them to a VC?
Yeah, I think actually, if you can rephrase the question, because I think I can tell you, intermediaries are fine. I mean, at the end of the day, if you've got a platform that's representing technology, there is money to be made from intermediaries, or in any possible way. I mean, you just have to look at Uber, but it depends on exactly what you're asking, I think, to be able to give you the right answer. I wouldn't want to guess without knowing that. The second question that you've asked is what customers scale VC investors usually consider for funding. Again, I'm not quite clear on that one. It could be the language, so I apologize if that's the case.
I think I know that one, Nick. I think
okay.
What stage do customers need to be at for VCs to consider them as within their range? So certainly profitable would be absolutely the first.
Even at VC stage?
The VC,
profitable, because that's definitely private equity for sure.
No, I can only say what I've come across in Cleantech, Nick, is they normally look for a profitable business that's demonstrated good growth over the previous 2 years, and they'd be looking to make an investment of between 1 and 15 million. Private equity for me is somebody that shows good profitable growth 3 years consecutively, 20% year on year, and is normally a 15 million plus check. But again, this is just my experience with the people that I've worked with.
Yeah,
there are quite a lot of angel investors and/or funds, particularly in Cleantech, based out of some of the hubs, London, Berlin, Munich, Barcelona, where there are quite a lot of networks of people who will bet earlier, perhaps even earlier than the VCs, that they're more likely to write a check for 15 to 100K. So there is that within the Cleantech, which I don't know how unique that is elsewhere, but it's certainly something which has grown in the Cleantech sector over the last couple of years.
Yeah. Okay. Well, hopefully that answered the question. I think it gives you at least a good steer. I'm going to jump into one that's come from Jonathan Watkins. I'm going to jump into this one first, actually, because it's a great question. And I've been involved in all of this. The question is, would you agree that you should be careful about bringing in big corporate types into scaling businesses? I have found you need a little bit more special forces in mindset, flexible and willing to operate without all the big business trimmings. Would be interested in your view. So I'm gonna agree with this fundamentally, but I'm also going to add a little bit of caveat to it because it does depend on the stages. So in the beginning, I agree that, and again, you don't want to stereotype here, the ability to be agile, the ability to be able to take risks, the ability to be able to, pivot. I hate that word, to be honest, but the ability to be able to pivot and iterate is crucial. So I like the terminology of that special forces sort of mindset. I think that the watch out though is you've got to differentiate mindset from skill set here. So if someone has been in the corporate world and they have the corporate mindset, which can often be, led by, slow moving bureaucracy, it's a big tanker, hundreds of thousands of employees, I can't really make change. Now that's not the same in every organization, but it can be typical of that. That mindset is not going to work. However, if someone comes out of corporate and their mindset is very much around pace and precision and all those things, you've got to look at the skill set that comes from being in that environment. And what I find is a business that goes certainly from startup to scale up, they do actually bring in a little bit of corporate experience, certainly the skill set, because the ability to work within defined cultures, proper structure, proper process, those types of systems, governance, those things actually start to matter when you start to get more scale. So I think the question here is you've got to think about the stages. What I would do is this, particularly what I said before about your network is your net worth and all that sort of stuff, is having some seasoned business professionals around you when you're at the early stage, maybe as non-execs or advisors, is absolutely a good thing. Because again, if you're presenting your pitch deck to investors and they can see that you've got a breadth of experience, you've got some blue chip caliber experience, as well as the creativity of the founders who are, they might have great educations, for example, but they haven't actually worked in the world of work in any major way. That blend and that balance is going to create a really rich mix, which will be very interesting to invest in. Okay, so hope that answered your questions. It's not, I think, an either or. It's definitely not a blanket, but that skill set and mindset is the thing that you need to focus on 100%. Anyone else want to jump in on that? I think I've.
Yeah, if I can jump in on that, I agree that there is. We do at Hyperion get a lot of people who want to join a startup from a corporate because they think it's beanbags and dress down days. And clearly, I think that alludes to Jonathan's point that some people don't get what being a startup is all about. And absolutely, you need the special forces mindset or the get stuck in, roll up your sleeves and make things happen mindset for sure. But going back to your point, Nick, it's around when you're hiring, I'd always think about where is the business going to be in 3 years' time? You're hiring for then, you're not hiring for today. To some extent, clearly the person has got to perform today, but it's very short-sighted to just perform to someone that's going to fix a problem today. Looking at your growth, where are you going to be? What size of company and where do you anticipate being in 3 years' time? Should in fact impact on the type of individual you hire. And also what your market strategy is. If you're looking to sell to and work with a lot of corporates or potentially exit to some corporates, having somebody that can navigate and speak corporate language is not a bad thing at all. So broadly, we all get the concept that, you don't want someone that has someone making their tea for them and doing up the shoelaces, but equally, you do need someone that's fit for scale. And when you scale, you do come across different challenges. And if you're wanting to exit, as I say, to a corporate, or you're wanting to sell into utilities, for example, which a lot of clean tech companies do, you've got to really understand or have someone that knows how to navigate those businesses.
Excellent. Yeah, that's a great build on what I was saying too. And you are the expert in this space for sure, David, in terms of capability. Okay, we've got one last question, and then we're going to start to wrap up. I'm going to pass this question over to Rob. So Jim has said, for a startup that has a little bit of tech software capability, but is developing more of a business model focused on scaling reproducible projects less than 300K a pop, could you comment on what project finance providers want to see as opposed to equity folks? So this is more about, as I said, debt, financing, credit, and those sort of areas, I believe, Jim, as opposed to just obviously trading equity for any type of investment. What's your thoughts on that, Rob?
Yeah, so I think when you're taking debt to fund these kind of initiatives, it's all about your means to be able to pay. So there needs to be a very, very, very clear plan on when you're going to be able to repay that money, what the terms of that repayment's likely to be, and a full risk analysis. So in your plan, where is it likely to go wrong? And most of the investors that I work with will be looking for that. They'll ask themselves, I'm going to assume everything's going to go wrong. Where is that going to happen? So you need to be watertight on your data and your forecasting and your management of costs, so the investor can see that they're going to get their payback. When you're looking at it from an equity perspective, I responded to somebody else's question when they said, typically what sort of equity would be sold during early stage investment seed funding. Normally you'd look at 10 to 25% as an initial offering, but much will depend on how much money do you actually need to be able to get your product to market or make the progress that you need, and what valuation do you currently put on your company that would decide how much equity that you would give away. Either way, either option, you need to ensure that you've got a really robust business plan. And this plays back to something that David said earlier on, in terms of how do you monetize what it is you're producing in the market. And I think that goes exactly the same. I meet a lot of founders that are really passionate about what they do, clearly very experienced, very intelligent, very innovative, but I often see a real failure in the quality and the robustness of their business plan to be able to examine the key levers in the business that are going to lead to the creation of value. And that means, as a shareholder, I'm going to see a return on the investment in the shares that I'm now buying. As somebody that is providing financing for debt, I'm going to ensure that I'm going to get the return and the interest rates on the repayments that you need to pay me. So having a really robust business plan, looking at those levers, much of which are linked to those 6 peaks that Nick was talking about, is the first point. And then the question is, how much do you want to give away in equity? Do you feel that, in terms of your value, it's the right thing to do? Or do you feel that you'd rather keep the equity yourself and that you can make those debt repayments?
Excellent. Okay, so that's comprehensive. Thank you for that, Rob. So what we're going to do now, guys, I've got a few people running off for dinner. So Eric has said, not boring at all, but I need to eat. So we're gonna finish things up now, guys. As I said, we're respectful of everybody's time. Thanks for everyone who's attended, and hopefully you've got a lot of value out of the conversation today. We've covered quite a lot of different things, and hopefully we've answered your questions effectively. What I'm going to suggest is, as I said, I covered quite briefly the 6 categories of investment and the areas where you need to think about in terms of creating a valuable business. If you'd like to go a little bit deeper in that, we have an assessment on that, which is called the 6 Peaks of Value Creation. It's a free assessment. It's literally about a 10 to 15 minute set of questions, which will help you evaluate as to whether you are focused on the right areas right now in terms of your journey, and the areas where you need to maybe put a little bit more intention, investments, thinking, all of those sort of things. So again, we'll put that out. Have a go at it. Again, if you like I said, it's a great tool just to give you a little bit of help on the journey that you're on. But I just want to finish off by saying thank you to my co-hosts here. So firstly, David, thank you for giving up your time and all your insights this evening.
Good for you.
And Rob, thank you as well for the same.
My pleasure.
Okay, thank you everybody for your time. I hope you have a great evening, and reach out if you need any more information. We're all happy to help at any time. Okay, thank you very much.
Thank you.